Everybody is freaking out about higher rates today, but suddenly forgets that the market gapped up over 3% on Monday morning. If higher rates stop this runaway freight train, you might actually thank the market gods that a higher low pullback entry is being offered, and you don't have to be the sucker buying this at the all-time high. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY weekly time frame chart because something very important has happened from a trend perspective. Remember that as of last Friday's close, we were technically underneath the lower high in the weekly trend count. Now, obviously, we can see that via Monday morning's gap up after the positive negotiation news over the weekend, we are no longer underneath that previous pivot lower high. And as a matter of fact, the partial gap fill reversal actually used that previous area of resistance as newfound support. So that's a bullish indication right out of the gates. However, let's think about this from a trade location perspective. Just because the weekly trend is flipping to up via a higher high finally, is this the best spot trade location-wise to just go out there and buy the market with both hands? Well, if you're targeting the all-time high, you might say that your reward might look something like this. And then here's where the location argument comes into play. If, in theory, the market pulls back and tests this previous area of support, which acted as resistance here, ideally, if sellers were going to continue the weekly downtrend, that's where they should have rejected the market. That didn't happen. We can use that as support again. In theory, if the market pulls all the way back to 550, that would still qualify as a potential higher low on the weekly trend count, and therefore you're actually dealing with inverted risk reward if you're only targeting the all-time high. You could also make the argument that, okay, if the market pulls back and closes the weekly gap below us, which I'm not saying that has to happen, I'm just saying it's another potential place for a very reasonable weekly higher low. Is that really ideal risk reward? You're risking 1 to maybe make something like 1.2 in the upward direction. That's pretty tough in terms of trade location. So what we're pointing out is that the weekly trend has flipped back to up via the higher high on this time frame, and it's certainly possible that a higher low pullback could develop, and this is where we start to get granular, moving down to something like the daily time frame. So as we can see here, we have blown right through via the gap up on Monday, the previous pivot high we were just referencing, which was also confluence with our daily 200 SMA. A stronger sell side market would not have been able to gap up and hold over that level. Rather, the market would have, if the sellers were stronger, faded and tried to find price acceptance back inside of the multi-day balance range we talked about from last week. It simply didn't happen. You can see that we actually got follow through in the upward direction. So what that would indicate to me is that this is a buyer's market. Now, once again, it's important to note that we have bulls in control here, but is this the ideal place to initiate a new money long? Well, if we think about what's happening here from a volume and candle structure perspective, probably not. If you look at the bar from today's session, it's a smaller inside bar inside of the Tuesday range, and it's happening on declining volume here. We did get follow through in terms of volume on the Monday gap up, and then we've seen volume taper off on the Tuesday follow through as well as today's inside candle. Now, this is not a direct indication that, oh my goodness, the market needs to pull back and needs to come back in and test something like this 577 zone, the daily 200 SMA, but it wouldn't strike me as being unreasonable if the market did start to pull back. And this is where we can take it one step further. We'll get to the hourly in just a second, but let's take the same approach as the weekly. What is the trend count here? Where are we? We're certainly sitting at the highest high. This is the low. This is the next higher low. This is a soft higher low because there was no hourly downtrend. Soft higher low happening here. No hourly downtrend. This is the highest high. We really have not produced a firm daily higher low ever since this equal low back here, equal to this lower wick from that previous red bar back there. So generally speaking, the market can afford on the weekly time scale and the daily time scale a pullback from the highest high in the trend count. Now, you'll also notice that I have this labeled with an interesting acronym, OHS, which stands for Overhead Supply at 590.25. Why might that start to become important? Well, if we zoom out here, you can start to see how this box from back here represents the overhead supply. If the market was going to pull back from a logical place, it would make sense that this is possibly that location. So if the market rejects 590.25, I would say that the daily chart, of course, can afford a pullback to the top of the gap. The daily chart, of course, could get a revisit to the daily 200 SMA. Can we use it as support now? If we move into the gap, sub 577, the market could certainly close the gap and offer a gap fill reversal off of 567.75. My point being, once again, is that we're seeking higher lows because the trend here is absolutely up. We've recovered the weekly trend as well. And I really want to drive that point home, right? This higher high gives us the right to look for a higher low in the trend count next. If you bring in the trend line, we know that the trend line broke a long while ago, but the horizontal level really rules all. Once again, if we just zoom in on these bars, it's going to look kind of funky on the screen because of how much range we've traveled. Notice that the lower wick of Monday's bar actually uses that previous weekly pivot as newfound support. That's a bullish flip. So I'm pretty, you can probably hear it in my voice. This is a bullish market, absolutely, but this cannot just overshadow trade location. If you're a trader in this market, we still need to be thinking about trade location. We've clearly established that, yes, buyers are firmly in control. This is starting to look more like a lockout rally in the upward direction. But let's not just be silly bulls and just get drunk on upside momentum, if you will, breaking out of a balance range. Let's go back to our principles of okay, where is there a reasonable place to manage our risk against? If higher interest rates are really a big deal, as everybody seems to be freaking out about, then a pullback should be welcome into the top of the gap, right? 577. Can we get a reversal here? And we'll take a look on the hourly chart in just a second. Can we get something that does this on the hourly, right? And then we get some sort of inverted head and shoulders. Let's rotate back here. Could this set a daily higher low? The answer to me is absolutely. Let's drop this thing down to the hourly times. As a matter of fact, before we get to the hourly time scale, just you guys know me, I love to be thorough in the investigation. Let's come in here with the Fibonacci's from the lows because it's so beautiful. Take a look at this. The Fib 38.2 is right on the money from this entire rally off the capitulation low to the most local high. The Fib 38.2 is right at the weekly line in the sand where I would really be looking for that weekly higher low to persist, as we were saying, somewhere in the neighborhood of roughly 550, the previous area of support that acted as resistance on the 90-day pause. That can now act as support again, lower edge of the weekly expected move. We blew right through that, obviously, and the Fibonacci is aligned with that also. If we come in from this low up to the most recent high, you're not really getting much confluence out of anything here. I would say if the 38.2 is going to act as support, it's just the bottom end of this balance range. If I'm being quite honest, from a technical perspective, I really would prefer if the market did pull back to close the gap. I would honestly like to see a higher low over the top of the gap as being more ideal than a full test of the Fib 38.2. What we want to see is previous areas of resistance now acting as newfound support after repairing the, quote, broken structure from the gap up on Monday. Let's clear that up. Let's take a look at the hourly time scale, and let's just read into some of the price developments through the session. On the Monday morning gap up, we always know that gap rules tell us the first base case we're looking for is a fade of the gap. Overnight inventory is skewed way too far in one direction in the case of a gap up on the net long side. And what we look for is inventory correction to move in the opposite direction of the gap. We got a little bit of that, but how much of the gap actually filled? Let's come in from Friday's high now with a fib. Let's grab the right tool here. Let's come from Friday's high up to the opening print of the session. The sellers were unable to even push for a 50% gap fill, not even a Fib 38.2 test on the gap range itself. So this inherently is bullish, right? You have to remember that when gaps don't close, it's just as much information as a full gap close and a reversal or a full gap close and a failure. The fact that the gap could not close continues to indicate that stronger sellers are just not participating in this market. You would think anyone with really strong conviction that, oh my God, the market's going to go to zero and this China tariff pause deal to make a deal in the future is just total fugazi. If that's your approach, these higher highs were a no-brainer short, if that's your stance on the market, right? Now, of course, as a technical trader, that's not really how we approach it. It's more of the gap rules framework. But point being is, in aggregate, did we see stronger sellers step up at this level and close the gap all the way? The answer is no. Wasn't even a 50% gap close, was not even a retest of the daily 200 SMA. We clearly closed higher on that Monday session, and Tuesday's a runaway trend day to the upside. Value is completely higher today, is digestion of the expansion we've seen in the upward direction. So as we're thinking about the types of participants in this market, it's very clear that buyers are in control. I would even take this one step further. I think the easiest illustration is actually to flip on over to the futures really quickly, because I already have it pre-labeled. But there were multiple instances on today's Wednesday session, right? After the Tuesday consolidation near the highs, end of day drop, right? Which is fine. That's just some end of day profit taking, I would imagine, overnight. Look at what happened today on Wednesday as we actually broke underneath the value area and underneath the overnight low. The market tested underneath those two key reference points twice, once here and once here. I don't know why I'm labeling both with twos, but there you go. Tested it twice under the overnight low. Did stronger sellers follow through the thin structure to get a retest of the Monday high? The answer is absolutely not. Stronger sellers would not step up there, and the consolidation persists higher. Now, don't misunderstand what I'm saying. It does not mean, as we said from a location perspective, that we blindly buy this market up here because, oh, Matt said stronger sellers aren't getting involved. It means if we start to see breakouts in the upward direction that look more so like Brigade bolts over these two equal highs, I would be looking for momentum to continue in the upward direction. If the market's trading in this range and Brigade bolts underneath this area, again, I would really not favor trying to short that, but rather, where can we participate in a higher low pullback for some sort of long entry to then rotate back in the upward direction? We typically do the pathing on the hourly timescale spider, so let's go back there. I'll give you the numbers. I'll tell you what I'm looking for. Any consolidation in here is consolidation that's bullish, but remember, we want to go with momentum when and if buyers continue to prove it. In my view, on the spider's cash, that has to be over 590.25 with a Brigade bolt. You could start to put your thinking cap on if we were to breach prior day's highs. Oops, let's bring out the other drawing tool here. Let's put in a level there. This would be the technical level that you would need to clear if you're breaching previous day's highs. Something along these lines. If you could Brigade bolt over 588.50, if you want to split hairs here, maybe there's a scalp for quick draw McGraw into 590.25, but really, this is the trade. Let's say it does a little dance here. This Brigade bolt, that's the next major range that I would say buyers can exploit in the upward direction, of course. So over 590.25 Brigade bolts, I would go with the momentum because we can clearly see here that buyers are in control. 594.50 would be the next upside target. If the market looks over 588.50, comes back down into range, I wouldn't necessarily short that, but I would be prepared for the possibility of a pullback that looks like this. So this is a look above and fail on the two equal highs from Tuesday and today's Wednesday session, correct? Under 588.50, breaking down through these lows with acceptance, which we just saw was not the case on today's Wednesday session. If the market accepts under 586.50, the pullback for the first higher low examination on the hourly time scale is 584. Right? So 584, 583, this little lower wick from the Tuesday session, closing this tiny gap that was there on Tuesday's open into Monday's high. I would be thinking about an hourly higher low at this location here. Why is that the case? Because, of course, we know this was a balance range. We broke out. This instantly is a higher high. There's plenty of room here for an hourly higher low. If the market makes a Brigade bolt underneath 584, 583, I would be looking for the Monday low to start coming into play. And that is also a place where I would be thinking about the possibility of an hourly higher low. Can we get a Brigade bolt here, which by all means, you could try to short this from A to B, but then at 577, the upper edge of the weekly expected move, still over the daily 200 SMA, can we find buyers stepping up at point B? I would really change my tone to look for something along these lines to see if we could make it back to point A, and then of course going on to produce higher highs in the hourly trend count. That would also continue the daily trend. If the hourly trend flips to down, how does that happen? You have to pull back from the highest high and you have to violate the last higher low. Obviously you have lows, higher lows, higher lows. So that would require this as a mild pullback, and then we would need to see something along these lines to close the gap. If there's an hourly lower high underneath 577, that is where the sellers technically have accomplished an hourly downtrend. But as we know from the daily time scale, when and if we approach 567.75, I would once again be thinking about a daily higher low. And at that point, if we were to see an hourly downtrend to get there, it would be a firm daily higher low. Remember, in the entire daily trend count, we made note that all of those higher lows were soft. There was no hourly downtrend. So if the sellers can do it, fine. Just show me the firm daily higher low, and I'm still interested in participating. Let's just show it as a double bottom here in some sort of reversal long off of this area, and then Brigade bolting back in the upward direction, trade the equal high, and then looking for higher highs beyond that. I would think that maybe the weekly slows down up against that 590.25. The weekly may need to consolidate for a bar or something like that after the gap up, but generally, this is the structure that I am most interested in. I am not interested in big new money shorts. Oh my goodness, the market's got to crash and burn and go to zero. I'm not interested in trying to short this up here, playing the hope card that, okay, I hope the market goes on to close the gap. That's not the game I'm playing. I'm playing the game where this is bullish consolidation until proven otherwise. Maybe there's a pullback to here. If buyers step up for an hourly high or low, fantastic, we'll trade to the equal highs. If we get below, we can take some quick shorts into 577 and then reevaluate. That seems more reasonable to stay in tune and in alignment with the higher time frame trends. Do not fall victim into saying, okay, the weekly technically gapped up. We've never seen a weekly gap not close. I have to short this thing right here, right now. That is a trap. If you trade like that, I guarantee you, you will not have a long career in the markets. With that, we will finish on the intradays with the VWAP cluster. Just to show you, we're above the entirety of the cluster. We're even over the Monday gap up anchored VWAP, right? So once again, is 584 just a made up, let me pull it out of thin air number? Absolutely not. It's the anchored VWAP confluence from Monday's gap up open. So there's that as well, okay? Those are the key levels. Those are the situations. If the market does pull back, again, that's fine. You know, if anybody who misinterprets and only watches the first 5 minutes of the video and missed this entire thing, that's fine. They'll be loud in the comments section, and that's cool. We actually we like that, right? It's kind of fun these days. Let's take a look at the market internals dashboard just to get a sense of what's going on at the exchange level. Does the pullback thesis seem reasonable based on what we just covered on the daily declining volume? We saw stagnation today. Is it reasonable the market might pull back? Let's take a look. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see? Well, today, as we balanced off, we actually did start to see some volume outflows. Okay, might seem reasonable that the market's getting tired here after a 3% gap up on Monday morning. What did the advanced decline line do? It's technically red on the session. How about the index score? It was technically red on the session and flat. It never really got into a trending mode with double digits. Not there. What about the cumulative build? It also went red on today's session. So as I'm thinking about what's happening at the exchange level, let's ask the question, are new money momentum buyers just blindly buying this up here as the market consolidates? No, it looks more like distribution, and the opportunity for a pullback is absolutely there. You would just need to see the first domino fall, which is price acceptance underneath this level right around in here. It's 5,900 roughly in the ES futures. If we just go back on over to the Spider's cash, it was this level there at 586.50. If you break below 586.50, we talked about looking for that move to 584, a very reasonable pullback considering what we're seeing here at the exchange level on the internals. Was Monday's gap up serious? Of course it was here. Of course it was here. We did get a index score that was building out positive, follow through to the positive side on Tuesday. The cumulative build on the tick, pretty flat on the Monday session. That's not unreasonable considering all the action happened overnight. But then let's look at Tuesday. Not really the most impressive build for a trending day with acceptance towards the highs on that Tuesday session. So once again, is it reasonable that up towards these highs, literally the highest highs of the move, is it reasonable that momentum buyers are slowing down? The answer is yes. Okay, so that pullback, very reasonable based on this evidence. Let's take a look over at the market profile and see what's happening from this perspective. If you're not familiar with this type of chart, take a look at the video tutorial in the top right-hand corner. What do we see? Classic P-shaped profile on the Tuesday session, which is indicative of two things. I would say because the market's been trending higher for a while now, and we're no longer really in the or just not even at all in the tariff turmoil zone. P-shaped profile typically indicates short squeeze, but I would just say that this is a rally with acceptance towards the highs, much less about short squeeze than it is a just rally for continuation after the Monday gap up with that euphoric move and, of course, the news over the weekend with the trade deal to make a deal in the 90-day window that we have. Tariff reduction from 145%, of course, down to 10%. 20% on fentanyl, of course, still, or fentanyl-related items, whatever that means. What do we see in terms of value from today's session? It's completely a normal distribution. This is about as normal of a day as you can get. Bell curve on its side, value point of control right at the halfback, which is the purple line on the screen here. It's really not telling you anything other than If the market breaks below the overnight low and basically yesterday's low, then yeah, the traders who are long late to the party, they're going to be disappointed. There's likely to be a pullback through the A period thin structure. I would expect the retest of the Tuesday low, Monday high. That's exactly what we talked about in the S&P 500 cash. The structure here is confirming out of the ES futures via market profile. I would also carry forward that we do have a poor high from the Tuesday session. So I and M periods there, back-to-back equal highs, does technically need repair in terms of auction theory, which might suggest if the market just consolidates, if we never get the break underneath something like, I don't know, let's say 58.95, if there's no break here and we're testing these highs, my first impulse would be, yeah, the market should break through that to repair the poor high from that Tuesday session. Let's get back on over to the other platform here, good old Thinkorswim, and let's take a look at the QQQ, the NASDAQ 100. Let's see what we can see here. So I'm not going to go to the weekly time scale because you guys, of course, are astute enough traders to understand this, but that's your weekly pivot high. I don't know about you, but this is certainly looking like a higher high in the weekly trend count, so it's bullish on that front. As you can see, we also get the same exact sentiment via the gap up on the Monday session as we pull back a little bit on Monday. It's hardly anything. That partial gap close continues to get acceptance in the upward direction, and today even you're not seeing as weak of a bar out of the NASDAQ versus the S&P 500. Now, it doesn't mean, again, that you should just go out there and blindly buy the NASDAQ at the highest high in the trend count, but what it might suggest is that your pullback here could be a little bit shallower than what we have in the S&P 500. You might just get consolidation in here instead of a pullback to test the top of the gap. It's very reasonable as a potential outcome. In terms of the trend count on the daily, of course, it's still up with lows, higher lows happening here, soft higher low. This was a little bit more of a firm hourly downtrend, noting that we did break underneath that Thursday low from the prior week, last week, technically, if you can kind of follow along with what I'm pointing at here and here. So even if you want to call this a firm higher low in the daily trend count, let's be honest with ourselves, right? Hopefully these yields that everybody's freaking out about puts pressure on the market to the downside, offering a retest of the top end of the gap or even a gap fill reversal, a retest of the daily 200 SMA. Show me the higher low. Show me the higher low. So on the daily time scale, honestly, anything that's over the top end of this balance, if you will, at 490.50 gap fill reversal, daily 200 SMA, count me in, coach. It's just looking like a continuation of the trend. And honestly, because this was much more of just an equal high, from the weekly perspective, that would also be a really clean sort of Brigade bolt back over a previous pivot. So I'm loving 490.50 as a potential level to the downside if the market pulls back. Something I find a little bit more compelling even about the QQQ, we talked about the daily getting some follow through here, but if I zoom out, we talked about the OHS, the overhead supply in the S&P 500. What did the NASDAQ do? It said, we're going to stop here? I don't think so. We're just breaking right through it, right? Break on through to the other side, fire up some doors for me. How about 519? Is it possible that we get equal high pullbacks off of that for something that looks like 510 on a pullback? That could also be a spot for a potential higher low, causing some upside in the market. So once again, the point of the exercise here is to truly understand your trade location as you're trading this, right? There have been no pullbacks. Buyers are in control, but the market can afford a higher low pullback, and a higher low pullback would help your trade location risk reward wise, setting up some sort of move to continue the trend here, which is now flipped even from the weekly perspective. Let's come in here with our good old Fibonacci's from the lows up to the highs of this move. Fib 38.2 well above the tariff turmoil zone here at 465.85. It's actually at the bottom end of this balance in here. I would say if the chart were to pull back all the way to the Fib 38.2, yeah, the daily trend may flip to down by neutralizing with some sort of equal low here, but think about the opportunity for a weekly higher low. Yeah, it would be ideal. Like, don't get me wrong. Would it be great if everything just stayed over 490.50 on the gap close? Of course it would. But if the market overshoots that, I would still be very much interested in a weekly higher low over something like 477, lower edge of the weekly expected move, daily 50 SMA. We have our Fib 38.2 as well from point A, the lowest low of the capitulation, to current point B, the highest local high that we're dealing with. Let's drop this thing down. I guess we could take the Fib from here to here just to be congruent. You're getting the Fib 38.2 in the midpoint of this balance range, a little bit less compelling there. I would say the 61.8, just in terms of the magnitude of this rally here, is protecting against that weekly breakdown of the tariff turmoil zone high. Let's clear that up. Let's get it on down to the hourly time scale. And what can we see from this perspective? Once again, not nearly as much of a test of the overnight low and the afternoon consolidation lows from the Tuesday session during today's Wednesday balance. So, very simply put, consolidation in here. Simple balance rules in play. There's no need to overcomplicate the market. If you can trade a Brigade Bolt on a quick scalp, I'm talking 5-minute quick draw McGraw, 2-minute chart traders, over 519 to quickly target 522 could be interesting. If you're really looking for follow through beyond that, 526, and I mean, it's crazy to think that the all-time high is just a hop, skip, and a jump away. Excuse me. Apologies. More impressively for pullback, people looking for the pullback, people looking for a reason to short this market, I wouldn't overstay your welcome on the short side, but let's just say we get some consolidation, we break, it's a failed look, look above and fail, lower high here, be my guest, call it a head and shoulders, call it whatever you want. I would say maybe we would entertain short opportunities through the thin structure retracement back here to the left on Brigade Bolt lower highs underneath, something like 515. Now, as we've said on the S&P 500, because the analysis here is going to echo that sentiment, when we get here, come on, that's an hourly higher low. You have lows, higher lows, possible hourly higher low here at 510, 508. If we can reverse off of it, the hourly trend persists as up. Fantastic. We're still dealing with a bullish market even on the small time scale. So if you want to try the short from point A, 515 to 510, you could try to pick up the 5 points in there out of the NASDAQ. But man, oh man, what I think that the long off of this pullback is far more compelling on the upside for risk and then reward back into the equal high. If you're like, nope, give me the full gap close, what do I need to see? Of course, it's just, maybe it stems from this look above and fail like this, but in all honesty, it has to be a lower high here, lower high in the gap, and then maybe you come down to that daily level we were just ranting and raving about, daily 200 SMA, 490.50. Once we get here, just like in the S&P 500, right, this would be the ideal outcome looking forward, trying to get follow through back in the upward direction to continue the trend after setting something like a firm daily higher low via the hourly downtrend that would happen from highs. Lower highs here, no hold for a higher low, right? That's the most important part. You get your equal low as we come here, and then you get your hourly lower low if you were to break down underneath, something along the lines of, what's the number in here? It's hidden behind those weekly expected move highs. It's 501.50. 501.50. All right? Let's move into our anchored VWAPs intraday. Clearly above the Monday, gap up anchored VWAP. Clearly this is hanging out in the gap. If you were to move underneath 501.50, you could watch out for it. It's kind of a mild supporting evidence piece at this point. These anchored VWAPs below are probably more of an interesting story when and if. Again, this is a pretty lofty, let me frame it this way. Would it be more interesting to participate in a pullback for some sort of higher low? Absolutely. Because I think it gives us structure to trade against. But I'm not saying that the market has to get here. The market does not have to get here to 590.50 by the time the week closes. That's not what I'm suggesting at all. The point of the exercise today is to say that more so buyers are in control. We've seen evidence of that. We're looking for higher low opportunities if the market does pull back, which might seem reasonable based on the exchange level data. If the market just continues higher, the lockout rally persists, and we'll just have to walk up these upside targets. Please just make sure if you're buying this up here, you can at least say, okay, I'm going to long it here on a break over 519. Like this might be one way to frame it, right? Where you say, I'm going to long here, stop underneath this consolidation low. So your risk is something like this box, and you're targeting the all-time high. Just to use that same example as the weekly chart, right? If you have risk and reward like this, then fine. Maybe you're risking one to make like two on the upside there as a swing trader in terms of being mindful about your trade location, right? So that's kind of how I would frame the NASDAQ here. Let's take a look at the internals for the NASDAQ side of things. You can see very similar, just weaker out of the exchange data, technically not negative on the volume flows. You are negative on the advanced decline line as well as your cumulative tick down here. I think it's mostly an echo of what we saw in the S&P 500. I would not get overly hung up on the idea that, oh my God, the NASDAQ's so much more bullish because the breadth flows are positive. It's mildly positive, but as we saw today, it's not like there was big follow through in the upward direction. As we take a look at the market profile for the NQ side of things, it's a rinse and repeat where value has progressed in the upward direction. Here's Tuesday. Here is today's session. There is no poor high that needs repair. Actually, today's session could use some G period. How much excess do we have up there? 3 TPOs, not bad. Not bad. So I would say that there's enough excess on the high of today's session to call that good. The auction does not really need full repair there. This volume is a little funky. Maybe some data breaks over from Tradeovate. I'm sure they'll refresh that for tomorrow. Point being is if the market's going to move in the downward direction, you would have to disappoint all of these longs. If I'm just using a round number in the NQ futures, it's 21.2. If you're underneath 21.2, all the longs late to the party from this area here say, okay, this is not exactly what we were expecting. Why is the market not continuing higher on momentum? I would think it's very reasonable to retrace through the thin structure in A and B periods, very similar to the comments we made over on the ES futures. Let's get back on over to the platform here. Let's finish up our 3 indices with none other than small caps, IWM, Russell 2000. What do we see over here? Certainly getting the gap up. Certainly getting the gap up on Monday. However, again, I'm not going to flip to the weekly chart. You guys are very smart. I'm sure of it. Weekly equal high, not a higher high in the weekly trend count. So the weekly trend could be said to start to neutralize here, but it's not nearly as much of a bullish development as what we saw in the S&P and the NASDAQ. If we were going to come down and close the gap, though, sure, that's still a place where I would be very interested in the opportunity for a gap fill reversal, because what it does is actually keep you above the weekly lower high pivot threat. You can see this labeled as major LH, which is major lower high here. This zone was danger for the small caps. I was going to say S&P, the small caps here. From the weekly perspective, if you've been tuning into the channel for a while, you know this. This zone was previous resistance, acted as support. This was where the sellers ideally would have yielded some sort of lower high. The fact that the market gapped up over that, again, it's not a higher high relative to the weekly pivot there, but it is a big step in the right direction in terms of preventing sellers from keeping price in this pig pen, if you will, from the weekly, almost yearly, monthly range that we had back over here, right? So progress. I know I said I wasn't going to have to flip to the weekly, but we've done it anyways. As we're looking about outcomes here, really have not seen as much strength out of these small caps, especially on that Tuesday session. It was a small inside bar, and on today's session, you actually made a lower low underneath Tuesday's low in small caps relative to the S&P, of course. And that might have something to do with interest rates. Obviously, small caps are a little bit more sensitive to that. But even if you're going to take the argument and say, okay, interest rates are going to absolutely destroy the market here, what I just showed you on the weekly timescale, and just referencing back to this zone here, still possible that a pullback just offers you a higher low for something that looks like this, or let's say it goes beyond that. If we could get a weekly sort of advance that looks like this, a pullback to test something like the 198.25 key level, right? You can see previous support from back over here. I would still remain optimistic pulling back from the daily highest high in the trend count, because the daily is lows, higher lows, soft higher lows here, firm higher lows here, highs, higher highs, so on and so forth. You get my point. We're pulling back from the highest high in the trend count here. Let's go on down to the hourly time scale. Let's see what else we can learn from price action. Pretty lackluster. Another balance is forming. We had balance back here, a couple of days, and then a breakout. So a couple of days, is it possible that we get a breakout that looks like this? Maybe. You'd need to see yields come lower on the 10-year perhaps. We do have PPI tomorrow morning, which should be interesting. Obviously, the CPI print on Tuesday was really well received by the market. If small caps do Brigade bolt underneath the 205.85, close the gap, that's fine. If this is taking place, I would just dial back long expectations. Size-wise, we'll keep that joke going in the comments section. For the S&P 500, so 205.85 Brigade bolts to 202.75, very reasonable, and probably looking to dial it back in the S&P itself. Let's quickly come in here with our intraday anchored view apps. We are underneath the Monday anchored view app gap up. Again, is this a shocker? Not really, considering everything that we've described so far in the discrepancy with small caps in the first place. Let's bring this over to the Russell internals and just check in on what's happening from this point of view. Again, is anybody shocked? I don't think we should be. Much more flat on the Tuesday follow-up. Outflows on today's session. Mild on Tuesday. Outflows or negative advanced decline line today. Cumulative build negative today and pretty flat on Tuesday. Also, seems reasonable that there's not really new money buyers up here. The momentum gap up was great, but nobody's really following it through in small caps in particular. If we finish up the Rusty with the market profile, what can we glean from this? It's actually the opposite of what we've been dealing with in the other indices. Another weird volume glitch. I wonder if I give this a refresh, if we'll get some sort of reload of the data. Let's go back to full screen on the Rusty. Yeah, look at that. Nice. Filled right in, no problem. So general takeaway is just that we have ourselves value, which has progressed lower. We have A period single prints up here. We have D period excess. It just seems weaker. It's all within the context, though, of what? It's all inside of the Monday range. So it's nothing more than a balance. You could make a small argument that value has progressed lower. You're not really finding acceptance towards the top end of the range via the A period breakdown. It's nothing we don't already know. With that, let's jump back on over to the platform. Let's finish up tonight's analysis with the S&P sectors, some supporting evidence, and then we'll get you on your way with the core list of companies and 4 additional trade ideas. So who was leading, who was losing, and where was the weight as this gap up was taking place? As you can see in this column right here, we have the semiconductors up 4.76%, followed by the tech sector up 3.22%, then it's discretionary, then it's communications. I don't know about you, but that's almost precisely in the order of the heaviest risk-on sectors first, leading this move in the upward direction. That is bullish. And keep in mind also, this does not measure from the previous Friday's close. This measures from Monday's open. So this is not gauging the gap. This is what's literally happened since the gap took place. We don't care about how the posture, well, I guess we somewhat do. We care about what the posture looked like in here. It was bullish. You can reference Saturday's video. But as the market gapped up, right, unless you swung trade over the weekend, which is a totally different story, but anybody who's gauging the market on a day-by-day, week-by-week basis, like we do here, this is positive, right? Moving from Monday's open, getting follow-through, it's been semiconductors, it's been tech, it's been discretionary. Those are the heavy hitters that should be leading a risk-on rally, and that's what we're seeing. The bottom end of the barrel, it's real estate down 3.25%, followed by healthcare defensive, staples defensive, materials, the lightest weight sector, utilities defensive. I mean, posture here really isn't bad. The only thing I might say is that it would be nice if financials could also participate in the upside. They're simply down about 33 basis points so far this week. It's not a scathing review. If financials were down, I don't know, 4%, like something along the lines of real estate or worse, yeah, that'd be a red flag. But 33 basis points is fine. They were acting as the early leader, if you recall, on the reversal off the lows from down here. Let's check in on the actual structural charts. What I find most compelling about this gap up is that it pushed price right to the bottom end of the OHS, again, overhead supply is what that stands for, and the market saw follow through on Tuesday, and it certainly got follow through today, consolidation over Tuesday's high for Wednesday's session. The point being here is it's possible the market slows down in this overhead supply, but even if the market pulls back, I want to echo the sentiment of what we talked about on the spiders and the NASDAQ. If the market pulls back, there is plenty of room for possible higher lows. You're talking about over 237. If we close the gap, you're talking about over 225.50. Probably don't want to get too much deeper than 225.50 gap fill reversal. If you do see something that's a little bit deeper, then the threat just becomes another subsequent lower high back underneath all of this overhead supply. We'll take that one step at a time, but as of right now, based on the candle structure, Monday, Tuesday, Wednesday, holding the daily 200, pushing into the overhead supply, buyers in control, thinking about either straight up continuation or pullbacks being A-OK for higher lows over 237. You can see the same exact thing here on the XLK. Here's your overhead supply. Here's the breakout on Monday with the close above, gap up, right? Tuesday gets follow through today's Wednesday session, also accepting in this higher range. If we take a look at where there's plenty of room for a higher low, it's over 226.75. Follow through that looks like this. Gap fill reversal ideally does something like this. For follow through, the threat would become if we move underneath the gap fill, something that then looks like that. Oof, that becomes a little bit more concerning for a reversal. As of right now, the candle structure would not suggest that as a high probability. Let's take a look at the XLY. Not quite into the double top neckline or over it yet, but a big break to undoubtedly produce a weekly higher high, plenty of room for a higher low pullback here, plenty of room for a gap fill reversal, stays over the daily 200, something that looks like this, also constructive. Straight up continuation also looks fine. One thing I will note about the XLY is a little bit more of the inverted hammer-esque bar from today's session. We looked over Tuesday's high, but then closed back down inside of Tuesday's range. It's not really a compelling story for continuation. It would seem to me that a pullback is very reasonable here as the outcome into the end of the week, more immediate term, right? Let's take a look at the XLC. We have broken for, a technical higher high, same story. Higher low happens here, all set. That's 98.60. If we Brigade bolt underneath that, maybe you could trade the pullback, but as long as we're over 95, looking pretty darn good out of the XLC. Let's talk about real estate. Rates obviously moving higher has not been friendly to real estate. We know that that's just simply how that works. I'd keep an eye on it. It's one of the lighter weight sectors in the market, but of course, real estate representing sort of the wealth effect, if you will, for individuals who own their property. Obviously valuations come down a little bit in a higher rate environment. You might want to keep tabs on that. Didn't really seem to spook investors down here. If you get more of a protracted down run in real estate, that might be something to pay attention to. Let's quickly jump to the XHB for home builders. Gapping up and still plenty of room for a gap fill reversal here. until maybe XHB actually goes on to make new lower lows, I might button up the wealth effect sort of theory in equities and just say nobody's overly concerned about it just yet until home builders and real estate itself is actually making new lows now that we've recovered and broken out over the top end of the tariff turmoil zone in both of the sectors there. Let's move along to healthcare. Healthcare is getting bludgeoned here, which I find is actually, it's a bullish data point. You're like, how the heck is this a bullish data point? Think about it like this. XLV is the fourth heaviest weight sector in the S&P 500, and yet the market looked like what it looked like today and even throughout this week. Even as the fourth heaviest weight component, yes, it's D for defensive, but it's heavy weight, looks like this. All it's going to take is a little bit of a, dare I say it, dead cat bounce to look something along these lines if the market supports off of an equal low here. And perhaps we're back in business getting that rotation to fuel the market higher as tech, as discretionary as something like communications take a little bit of a break into the end of the week if this pullback were to persist. So if healthcare can take the baton basically and the baton can get passed, rotation keeps me bullish on the broad market if it pulls back. If your pullback is led by healthcare, fine, no problem. That would be a big bullish indication in my view. Let's take a look at consumer staples, breaking the 80 handle. Not great, although it is D for defensive. We definitely don't want it underperforming, or I should say not underperforming. Underperformance is fine, but we don't want just a blatant divergence in terms of trend and development. Would have been best if this broke out, maybe failed, and then made a move after you sort of got the tech follow through. Not seeing that right now, so not overly thrilled about that, but lightweight sector. Lightest weight sector is the XLB. Fine, pullback, gap fill reversal seems reasonable here. We'll make note of it when and if it breaches underneath this zone there. Until that happens, because it's such a lightweight sector in here, it's just helping the S&P. If it does this, even better, more help. If it does this, we'll start to make note of some downside pressure. Utilities, look above and fail. This is more of like what I wanted to see out of the XLP. No problem. No problem at all inside of this balance range. Fine. Does not strike me as a threat. TLT, we'll talk about yields momentarily. Bonds falling off of a cliff here, back down to the 85 handle. I don't know that I would be a bond buyer on 3 equal tests, especially coming in now after a lower high. I think if rates really are going to be a big deal, a big issue, you're going to need to see much more follow through. And we'll get to the 10-year chart in just a second. Let's go to financials first. Let's finish the sector picture before we talk yields and such. If we're looking at financials, I love the follow through over this level and the small little consolidation that's happening here. I think it might be a little bit of a pipe dream to just expect that we continue to get the consolidation and follow through. I think a pullback is totally in the cards. But it's what? It's another higher low, as we've been saying across basically every sector that's meaningful for the S&P 500. So all set from that view. If it does consolidate, if it proves me wrong, by all means, I mean, it's just going to help the case for the bulls in the S&P itself. Let's finish up with energy, sort of getting away from the recession narrative with the breakout of this balance range. I sort of reduced the length of this line, but just remember that energy, at least the top end of the range from here, it's the bottom of the gap now, did represent the previous bottom end of the range over here. Point being is in a more recessionary, concerned environment, crude would not be recovering the way it is. It would still remain depressed because what it's forecasting is that demand is going to absolutely collapse. Nobody's going to have money for anything, and oh my God, it's the end of the world. It's not happening here in energy, and you can even see that crude is back over the 60 handle on the barrel price. We've been talking about this for a while. Next step here would be, I don't even know, is this back adjusted for the contract change? It is. Okay, so that's a good thing. We want that. The next breakout that's key for crude on the chart here is up and over something like 63.75 a barrel. Would start to get even more comfortable to avoid that recession narrative. We'll watch out for it, but just being off of these lows is a positive indication here. Let's jump into our ratios and see what's happening from that point of view. We have, of course, if you're not familiar with this dashboard, a video tutorial for you in the top right-hand corner. I don't know about you, and we've been posting about this. You can go read the X threads, right? The mega thread of analysis whenever a new week closes. Green shoots persist. I would say that this is a little bit more neutral. Green shoots persist here. This is risk off anyhow, or I should say it's defensive, so it's a non-issue. I'll put the X there. This is fine. This is indicating that risk off is not dominating the relative strength. Same thing here out of utilities. If we take a look through the specialized ratios, oops, that's the same one. Let's go to specialized set A. You could see that we have green shoots persisting. That's bullish. This is bullish. This is massively bullish as they basically move as exact opposites. You have semiconductors at the top and then, of course, healthcare down towards the bottom. So exponential out of your recovery on that. Still a risk-on indication. Even the ARKK is starting to outperform the S&P on the breakout of the long-anticipated pattern we've been talking about, which, of course, is the inverted head and shoulders. New break of the neckline is bullish and a risk-on indication. Now, again, We're seeing these bullish signs across the supporting evidence that we're looking at so far, but it does not mean that we just ignore trade location. It's sentiment about who's participating in the market. Is it being driven by the right things? It doesn't mean just go buy it right now. It means that, yes, the core move in the upward direction is happening on a solid footing, a stable footing, not an unstable one, not one where you're going to say, this is just it's a bear market rally, right? There's not a bear market rally as you're seeing green shoots across all of this bullish supporting evidence. Gold on the ratio, not inverted, but rather regular, head and shoulders cracking the neckline underneath the 50 SMA. We all know that we've been talking about the big divergence in gold versus the ratio. Gold itself had much more of an equal high, whereas the ratio, not so much. That was the sign. That's bullish. If we take a look at, excuse me with the cough again. If we take a look at Bitcoin, breaking out over the 100 handle. We talked about that in the weekend video. Sailor Shift Tool is still screaming a solid buy signal there. If you look at TLT ratio to the S&P, it's risk on for equities as bonds basically get plundered here. So speaking of, perhaps we can start to take a look at the dollar, interest rates, so on and so forth. Rates are moving in the upward direction. Now, everybody's freaking out about the move higher in rates, and yes, rates are generally speaking towards the same location, and this is the argument everybody's making online, which is just nuts, right? Rates are approaching the same place where Donald announced the 90-day pause blanket, right? 90-day pause on all tariffs, excluding China, so on and so forth. And now we have a new 90-day pause, and yet rates are like at the same level, right? That's a lot of people's argument online. So, oh my God, the market's going to crash. Again, the market can pull back. I think if rates cause the pullback, then fine, no problem. We're seeking a higher low. And if you think about this just all up as well, let's grab more than a year's worth of price data. Let's grab like 5 years. I mean, what have rates really done? Yeah, they've ebbed and they've flowed inside of this balance range, but what have they really done? What have interest rates really done? Nothing. Absolutely nothing, right? And we know that to be the case anyways because the Fed stopped hiking rates, so in theory, rates shouldn't get too crazy on the upside, and they're not cutting rates either, so we shouldn't expect rates to be down at 1% on the 10-year yield. It's not going to happen. So rates really are, it's wild to think that people are making such a big deal out of these rates at literally the same location as to, let me just throw the S&P up here for a second. Let's throw the S&P. Let's do a little comparison this way, top and bottom. Let's go back to 1 year charts on both top and bottom so the cursor syncs. And there we go. So this is your 90-day pause right around in here, right around in here. That's your rates coming down. Now we're at the same level. Look at where the market is. It's not even the same market. You're telling me that even if interest rates do put some downside pressure in, you wouldn't buy the higher low here, looking for an uptrend to persist? Phew, maybe you know something I don't, but 9 times out of 10, markets tend to go up, right? And that's we'll get the trolls in the comments on that comment from me, undoubtedly, but markets are designed to go up, right? We have infinite bid 401k. So even if yields are seemingly high relative to their overall range, the market's in a totally different location, right? Look back here, where rates are literally scratching at 4.8%. You pulled back, right? And then what happened? The market still went on to go make new higher highs. Now you could say, oh, but it was precursor to this big breakdown. Fine, whatever, right? That's the tariff turmoil. Unless there's a new announcement of new tariffs, I do not think we are going here, even if rates reapproach something like 4.8. If rates get to 4.8 and the market pulls back, I'd still be thinking about a higher low, even if it just means that the market goes sideways. Be another place to look for trade opportunities to set up that align with the bullish thesis we've set forth thus far, which, in my view, it's not like this is not just a subjective, I feel like the market should go higher. We've looked at all of the data points. We look at the data points every single time, and we make an assessment. Are we in an uptrend? Are we in a downtrend? What are the internals doing? What's happening at the exchange level? XYZ. Let's take a look at gold in isolation just so I can continue to show you this. Massive divergence versus the equal highs in the gold price itself. We're technically under the neckline. RIP. Nobody's running into gold anymore as a safety haven instrument. If we look at the inverted ZT, small uptick here, just continuing to indicate that we probably aren't getting 4 rate cuts, never mind even 3, into the end of the year. So speaking of, let's take a look at the Fed tracker tool and see what's going on over here. You've got 91.7% odds of another pause in the June timeframe. I think that's a result of the solid labor data we're continuing to get. Anecdotally, Microsoft announced some layoffs this morning, but we know that the continuing claims ticked down last week. We'll see what tomorrow morning's numbers have for us. And CPI so far was not out of hand on the first wave of tariff inflation, and perhaps right? Just perhaps if things go amicably, geez, that's going to throw me off, between the US and China on the resolution of the trade deal, you might not see supply chains that are completely uprooted and destroyed and persistent inflation based on the rebuilding of the supply chains for, years to come, like what we had to deal with coming out of the wake of the sickness, right? In terms of the rate cuts and the magnitude of the number, right, you're still getting 1 and 2, as we just referenced, no longer looking at 4, which honestly, the less rate cuts that the Fed is pricing in, the more confident the market is that we're going to avoid a recession and we're going to need Fed intervention. So take that for what it's worth. As we look forward to what's on the docket for the remainder of the week, I suppose we could look back before we look forward. CPI pretty solid here, beating the expectations on that front. The only thing that came in line with expectations was your core year over year, which I don't know why they don't show it on the previous screen. Anyways, there it is, 2.8 actual versus 2.8 previous at 2.8 consensus. Everything else was underneath. If you actually take a look at what was driving inflation, it was core services. It was not even core goods, and it was not just all items all up. Goods inflation was not a factor here. It was the move in the core services, which brings me to my next point, which might be something along these lines. What's the major component of CPI? Like 50% for those nerds like myself who have done the research, 50% roughly, I think it's a little more like 48 point something, 50%-ish of CPI comes from shelter. If you look at asking rents for all bedroom types, they actually ticked lower, right? So in terms of seeing this massive inflationary spike, even if goods do see an uptick, it looks like the shelter side of inflation is actually getting movement in the proper direction to alleviate what we were dealing with the nasty inflation through the sickness era when the unlimited money printer was turned on, right? We're not seeing that. We're seeing inflation on the bed, rent, shelter, owner's equivalent rent move in the right direction to ease up on the pressure consumers are feeling. Now, again, the price level is still elevated, but it's just not continuing in the upward direction. This is not happening. It's more so doing this, and this would actually suggest that it's actually starting to do something that looks like that ever so slightly. Okay, that is what we've got on that, and if we want to have some fun, some laughs, eggs are technically down 12.7% in the month of April. So eggs, no inflation in eggs. Deflation, massive deflation in eggs, 49% back here, down 12% in the last read. The other fun one that we looked at the other day, as we scroll down, just I don't want to kill too much of your time, but at the very bottom, where is it? Oh, very bottom. I don't want to waste your time. The public transport fees, where's fees? There's fees. You could find it in here. There was fees that were up. Parking tickets and fees were up in terms of inflation. Anyhow, jumping on over, I said we were going to look back after we look. No, we're going to look forward after we looked back. There we go. PPI is what's upcoming. It's going to be plastered in there with retail sales, jobless claims, Empire State and Philly Fed Manufacturing Index. I would really say that this is our main watch. PPI should be interesting, but it's all about the labor market right now based on the Fed's scrutiny of whether or not it's deteriorating, and we will get opening remarks from Powell at a conference in the nation's capital here, the Thomas L Research Conference in Washington, D.C. So we'll be live up in the Penthouse office giving you guys the breakdown of what he's saying. We'll maybe even beam him in to the office stream tomorrow morning, 8:40. We'll see what Powell has for the market and how the market responds. Earnings calendar. I didn't look at CoreWeave so far, but CoreWeave is very interesting on the data center front for AI, and they are reporting after the close here. We'll take a look at the ticker. I know I always say that, and then I never do. We will do that immediately after flipping off of this calendar, but keep in mind that Applied Materials is probably more interesting after the close on Thursday for the actual semiconductor sector itself. This is more so the real estate and the data centers that basically power AI in and of itself. So with that, here is making good on my promise. Let's go CRWV, CoreWeave, and in the after hours, currently trading up here, 6208 by 19. Let's see if we can go split screen and turn on the extended hour session. A little bit of a pop and then fade here. I will be interested in reading the actual report. That'll be some homework that I have once we get this video all wrapped up. So CoreWeave, possible for some sort of pullback to unfold here, but generally not detrimental earnings. Not, oh my God, we're back down to the IPO opening print. Not, oh my God, we're making new lows. Mild pullback, mild pullback. If we could stay over this previous pivot high, that might actually be an interesting spot for buyers to step up. What does that look like? What is this? This is a closing bar. I would really start looking at something like 59.50. If price could stay over that, not bad. Not bad if you could stay over 59.50. So that is your CoreWeave chart. Now let's get back to our typical indications here. We're going to kick things back off with bonds relative to themselves. On the heels of CPI, this little uptick here, it's the possibility of an uptrend reversal, which continues to indicate that the Fed is not going to be easing rates as aggressively as the market may have thought, which, as we've expressed prior, might actually put less pressure on the recession narrative. So if this actually flips into an uptrend and this remains elevated, market's just sort of concerned about the inflation front, and what we want to see happen is the avoidance of any big deterioration in the labor market. Otherwise, if we do see deterioration in the labor market, this will immediately snap back to the downside as the market forecasts Fed intervention. So far, so good. I would much rather deal with a higher rate and a solid labor market where people still have money to spend and things aren't really breaking down. The market's concerned about inflation, but we're not really seeing it ramp back up. That's what the April report would suggest, at least. This outline here is pretty, it's much better than the stagflation. Oh my God, this should be drilling to zero, and this is off the charts in the upward direction. So liking that development, let's move into credit spreads. Positive developments on the gap up from Monday, moving lower here. That's more risk on for the market. If we take a look at junk bonds, a little bit of an issue, right? And obviously this has a little to do with interest rates, or at least the non-belief, if you will, of the bond market right now. So pulling back here, the most egregious one is really the LQD, which has been massively divergent to this move higher that we've seen in equities here. So once again, is the pullback narrative okay? Is it fine to be thinking about a base case over in the S&P 500 as a pullback to offer this, or even offer something that looks like this? I think that's totally acceptable given what we're seeing in some of the supporting evidence. Buyers still in control, but maybe a short-term, too frothy here in the upward direction. Bitcoin, we looked at the chart already, so all set on that. It's risk on. Let's take a look at breadth, continuing to expand here in the upward direction. New highs versus lows is pretty tame. So I would have expected a little bit more of a pop here on the big gap up. So that might be a small warning shot across the bow, but once again, whole thesis of today's video is what? Well, if we get a pullback, it's not unreasonable to set some kind of higher low. Let's move into some RSP. Big gap up over this previous shelf. The big thing to watch here was just, okay, is the broad market in its entirety equal weight going to also take out the weekly pivot? The answer is yes. That's helpful. And of course, the QQQE has been moving more so in lockstep here. Same concept, all set with the higher high. If we take a look at volatility, I skipped to the VVIX, but we'll just throw the VIX in down here. Small uptick on today's session as we get a little bit tired out of buyers in the S&P VVIX, also waking up a little bit. Is that reasonable, once again, considering what we've seen? Is it reasonable, considering that the market might be a little bit nervous about what's going on with interest rates here? I think it's very reasonable. I think that we've seen a big expansion of range in the upward direction, right? Remember that markets move from compression to expansion, back to some sort of compression. It could either be sideways digestion via time, or it could be digestion via price, retesting a previous area, a breakout, right? So all set. Not really seeing big volatility flashes that are like, oh God, watch out. Not seeing it. Take a look at vol futures. They're still in contangos. This is a bullish development that we talked about in the Saturday update videos. This is also looking fine, and the one-day VIX is still on the local lows here as we're trading at local highs in the S&P. No major divergence from that point of view. Skew we haven't checked in on a while. This is the first time I'm looking at it today as well with you. No big change. Remember that 113 is folks throwing in the towel on the black swan events, so no big. It's not at a point here where I would read into the skew. So with that, we'll just drop this back over to this dashboard. We'll jump on into our core list of companies, and we'll get you out of here for tonight's episode of the weekly watch list. Here is NVIDIA. If you don't know what a lockout rally is, if you've never heard the term lockout rally, well, here you have it. This is a lockout rally in the upward direction. You guys know me here on the channel. We use different colors to represent different things. Yellow, of course, represents gaps. You'll notice that we have 1, 2, 3, 4, and now 5 unfilled gaps in the upward direction. The market has basically gone from the lows straight to the highs with no offering of a substantial pullback. That is a lockout rally. It's very difficult to participate in a lockout rally unless you're long from like here and you happen to be swinging this overnight into the Monday session, holding through Tuesday, so on and so forth. Very difficult to participate in unless you're a buyer down here and you have a much longer time horizon. As short-term traders, what we want to be careful of here is trying to short the market. You don't want to try to just short NVIDIA on, arbitrary moves. So the only times where you short this because you think, okay, I can't buy it here because there's no risk or reward left to the upside, but I also want to be cautious about my shorts. You have to short it, when and if there is a gap up into resistance. This morning was a great example of that. Let's go to the hourly time scale. You can see this. We gap up this morning. There was a rally into resistance, 134.75. That is when you have the ability to short the market because the stop is so small. If you're wrong, you immediately get out of the way and you say, okay, I do not want to get run over by a freight train. If you're right, this is where at least you have some semblance of risk reward, and you can watch for a rotation to the opening print. Through the opening print, some sort of gap close to the downside. That's ideally what you're looking for to exploit risk reward. This morning, great example of that. So walking forward, what might we say about NVIDIA? What is left here to actually do as a trade? Well, it's bullish nonetheless. Let's go to the daily. Let's zoom out. I'll give you an all-up analysis first. It's bullish being back inside of this overhead supply, the fact that the market did not reject off of 129. Therefore, we could say that pullbacks over 129 would be bullish for a potential higher low. The market could even go under 129, offer a higher low on this gap fill reversal, staying over the weekly lower high pivot here at 123, and remain on the bull side also. If the market is going to continue via some sort of gap up, once again, I personally find this very difficult to chase at the highest high, and the only trade that I would really entertain is if we gap up over 137, rally to 140, 125 intraday, and one strong push off the open. I would say, is there a reversal pattern at the 140, 125? And just for, in terms of, again, using this beautiful example, let's go to the 2-minute chart here. Ooh, can't use a 90-day. Let's go to a 10-day. Look at this. I mean, could you have asked for a better setup? And I'm honestly, this one is, it feels good to get that one under my belt after a pretty flat start to May. Finally getting a little bit of a runner here, short the lows, target this, and then some gap close. Nice to get some runners on NVIDIA today. Regardless, moving forward in terms of trade ideas that we, will monitor for into the future, it's all about those next levels overhead. 141.25, previous pivot high 143.25. If the market gaps again and runs with a short setup into those levels, maybe a pullback, but I would just be cautious of buying it long. That's my main thing, is not being the sucker at the highest high. Next up, Microsoft. And, obviously, anybody who swing trades this from the close of Friday into, the high up here from today's Wednesday session, you made boatloads more money swing trading it long, right, with a higher time frame perspective than scalping it short intraday for just a couple of bucks, obviously, right? So I'm not trying to sit here and say that one NVIDIA trade is a hero trade. It's not. Just sort of telling you my perspective as an intraday trader. So we look at Microsoft. What else is going on here? Pullbacks over 447, consolidation over 447, inherently bullish over this previous shelf of resistance here. As we look at the hourly time scale, hourly uptrend, of course, if it pulls back, you might have another nuanced level just shy of 450. If you pull back to that, maybe support there for rotation back into that resistance. Honestly, the daily chart, a lot of these daily charts, if I'm being quite frank, are getting a little less attractive to actually trade. The broad market seems best watching for that pullback. NVIDIA was a decent setup today. It would have to set up again. A lot of these things just sitting on the higher highs are not really offering decent trade location, in my view. Apple is one that is, but it moves like a snail, right? If this is going to be a double bottom, we have the gap to close overhead. I like the consolidation here over this previous pivot high back at 206.50. Consolidation persists, maybe something that looks like this, breaking out of a 3-day range, recovering, the daily 50. That could be interesting over 213. Something along those lines. But once again, manage expectations. If you're trading Apple, this thing typically moves very slowly. You should not be looking for a scalp unless there's a catalyst, right? If there's a catalyst, then perhaps. But 213, 220.75. I would not be short for this, looking for a big gap close to the downside, just noting that the trend is technically up via higher lows, and you're just kind of trading in the midpoint of a range if you're at that gap to the downside. Amazon, Nancy, what do we have here? This is a little bit more compelling on the short side, noting the look above and fail from Tuesday as the broad market was rallying and closing quite strong. So what does that set us up for? I mean, the 90-day pause on the China stuff was obviously telling for Amazon just because of the goods that a lot of Amazon sellers are importing. But if you get consolidation here and start to get consolidation in the lower third of this as just a range, again, look above and fail on the daily level, rotating for now a candle close inside of Monday's range, I'd be very interested in this possible trade underneath 206. If the broad market's pulling back aggressively, Amazon is probably a spot where I'm looking for some sort of a rotation to the downside. You have some mild levels in here, 203, $200.25, 197.25. Daily 200 SMA would really be the primary target for me, at least. It's a firm level as well from the daily at $200.25. $200.25, daily 200. If you look at the daily time scale, it is this level right in here. So it's the top of the range, which acted as brief support, then the lower high underneath. $200.25. Next up, after Nancy is Google. I hate this chart. I'll just say it right up front. I really am not a fan of this chart. You've got these flat top highs, but you're technically coming from a lower low. There's been a really impressive recovery after the AI Apple search headline that broke Google back over here. I just don't like the chart. I don't like the chart structure. I think if it pulls back here, maybe we entertain long ideas over this balance low from back around 161.50s, maybe something along these lines, but the setup is not clear to me. I would think if we do break through these after coming from a lower low, not a higher low, I would think that the market really struggles with that breakout and does not continue to aggressively move higher. You'd be sort of the suckers long buying a breakout there. Maybe Google proves me wrong, but it's just definitely not a location that I'm overly interested in. If anything, it would have to come up, test the 200, then really Brigade bolt it over 166.35 for something like that, perhaps into the future. Metaverse, what's going on with Meta? Up and away. Inside consolidation in the upper third. Big recovery over this is the most telling. So if Meta does pull back, I'm really interested in 635.25 longs for rotations that do this, back up towards those highs. If Meta breaks below that, I'm not short below 635.25, but I am short for the gap close here, just noting that we would be underneath this previous pivot on the daily. So we took a look at the hourly chart, Here's just bull flag consolidation. I think you treat this exactly like you treat the broad market. You've got this little balance range. If sellers are going to take the lead here, if buyers are going to end up sorely disappointed, it comes from a thin structure retracement. Again, I would be less interested in that. It's the first step to getting that higher low pullback we just referenced on the daily. It's also the first step, if it's going to get worse, for this, and then the gap close on lower highs persisting under 635.25. Moving along to Tesla. Been a little bit of a heartbreaker recently in terms of intraday fakeouts before getting follow through. I'm not going to lie, on that Tuesday session, kind of brutal. But what's it got going for it? It's certainly the recovery over that 326.50. If price can get a pullback above that, that's great. If price gets a pullback well above the neckline of this as an entire double bottom neckline, as a bull flag breakout on the right half of the double bottom, that's also pretty fantastic up against 303 in here. So Tesla, anything goes. I would think that the bullish pullback is the name of the game for better entries on the long side. Today's gap fill reversal, honestly quite nice, but NVIDIA took the cake there. For tomorrow, consolidation here, I would entertain Brigade bolts over prior day's high, just noting how equal all of those hourly bars are up against 349. This could be a trade, right? If this is consolidation, Brigade bolt here, that is a trade. Risk, that's not drawn to scale. Risk, hopefully tighter, right? Reward, something like that. Risking one to make perhaps 2.5, something like that on the upside. Any consolidation that breaks down, I'm not really interested in shorting this. I would be more interested in being a pullback buyer at the levels we just described, 326.50. JP Morgan, what's going on with Jamie Dimon? Equal highs, driving financials straight back to all-time highs. We know that the actual performance of the XLF is pretty flat this week, but for JP Morgan, not bad. I could see gap fill reversal staying over this previous high. That's 255. I could see consolidation in here. I could see this Brigade bolt, preferably clearing this 266. Not overly hung up with the 270s because this thin structure on the breakdown, here it is on the hourly time scale, that really opens things up. Right, so over 266, previous resistance, right? If we could get a Brigade bolt, I'm just going to draw it here, something that looks like that in the recent time frame, right? If we could get that first target 270, then it really opens up, as I was saying, through the thin structure into 277.50. Netflix, beautiful textbook, put it in the history books. Here's a bull flag. Let's see if it can't break out up and into blue sky territories over 1160. No need to overcomplicate that. Here's 4 trade ideas for you. We're going to start from pretty obscure to the fan favorites. So UNP, Union Pacific. Yeah, that's right. Freight. Rail. What do we see here? A failure of the sellers to break down into the gap down below, and instead a bullish hammer recovering over the daily 50. We've closed inside the 2-day balance range. If we can get intraday, and you probably want to trade shares on this, the spread on the options is pretty wide right now. If you could get this, you're looking for risk and then reward in the upward direction. Very simple look below and fail. Here's a balance range, here's a look below, here's a failure, except inside, if we can establish risk up against 227, worth looking for a rotation into the equal high. If it goes beyond that, there's a gap to close over 233 into 234.75. Not interested if price starts consolidating down here. I would think maybe over time it closes the gap below, but I'm just not interested in that trade, noting the strong response from the buyers off the lows of today's session. That's UNP, Union Pacific. Let's move along to another lesser fan favorite, which is BA, Boeing. And Boeing is interesting on the short side as a look above and fail. It's not a multi-day balance range, but if we take a look at the hourly time scale, you saw the daily inverted hammer. You can see that Boeing technically opened right at the prior day's high, looked above, failed to close back inside, and you could honestly build out, if we want to get a little level happy here, we could come in with 205.65 is fine. We'll make that gray dotted. Good. If you get lower highs here, left, head, right shoulder, under the neckline, kiss it goodbye through the thin structure. You're looking at 198.50 as a potential target. So if we need shorts, Boeing could potentially be that short on the look above and fail. Broke over a previous day's high, closed inside the previous day's range. Very obvious shelf of support that, if broken, could yield this close. It's actually a little gap close as well to that 198.50. Next up, let's take another step closer to some fan favorites. Reddit, RDDT. Newer IPO. Let's take a look at the daily time scale. This is a little bit of a longer time frame idea, but undoubtedly left, head, right, neckline getting tested on today's session. We didn't quite close above, we closed on it. If we can get some follow through up and over that 125.25, in theory, I'm looking for 157.25. This is a longer term idea. This is something I may honestly entertain as a swing trade in a separate account. The more I look at it, actually, I'm almost like convincing myself here this afternoon that this is a good trade to put on. We'll see. We'll see what tomorrow brings in terms of follow through over the neckline. I like the high volume relative to some of the other volume that was very light across the broad market. We shall see. What I want to avoid basically is putting on a long trade here in Reddit as the broad market's pulling back. Ideally, the broad market would pull back. This consolidates in the right shoulder. The broad market starts to catch a footing again, and that's where we look for something along these lines, your added strength in Reddit. Then finally, the fan favorite, the holy grail of them all is PLT. Do you know where I'm going with it? Palantir. Very similar to Boeing in the sense that you have an inverted hammer at the high, look above and fail, closing back inside the previous day's range just by a hair. But what I would want to see here is not the short, but rather the pullback long off the top of the gap, off of the previous all-time high. This is a classic Brigade bolt. This is a Brigade bolt that I would take almost 10 out of 10 times. A break through a previous all-time high, a pullback to that previous all-time high. I want to be long here targeting the new all-time high, and then I want to possibly look for follow-through in the upward direction. So underneath today's low, tomorrow, if you catch my drift, right, underneath this level in here, I'm looking for pullback longs in this area. I really don't want to be short from A to B. Down here, I would prefer to look for the longs in this area. Could you maybe scalp this like that? I'm not going to say it's impossible. But Palantir, with the strength it's had recently, let's make that gray dotted, of course, that would be a possible mistake, trying to short this into the move. I would much prefer to say, okay, where's the move that looks like this, and then long back to the all-time high, right? That's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new during today's session together, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that tomorrow morning there's a ton of news. There's even Jerome Powell speaking at 8:40. We will be live here on the channel as we are every day at 8 o'clock Eastern Time sharp for another episode of the pre-market prep. Of course, that will go through Jerome Powell's commentary at 8:40, and we will see how the market responds. So come on out to the office tomorrow morning, live here on the channel for another episode. We'll see you there. With that said, have a green trading week, and I will see you in the next one.